Welcome back to the training program on finance for non-finance professionals. In our earlier session, we had focused on the various investment mechanisms like capital budgeting. How does a particular company evaluate a capital project? And also, we have looked at from a short-term capital management perspective, which is the working capital management. Now that we understood how the company will try to evaluate its investments, the next important aspect for us is how does it raise the capital? What are the various sources of financing or funding a particular business? Because today that's the world which is expanding very heavily. A lot many varieties of financing have come up. So it's almost important for every professional, whether he is from a finance or from a non-finance background, to understand what are the various modes of financing that are available, the advantages and disadvantages associated with each of them, in what circumstances people prefer one mode of financing to the other. Understanding all these elements forms an important part of the finance understanding. All right. With that as the background, let's just step into it. Whenever we talk about the sources of finance, there are two major classifications I look at. One is the internal source, which means some kind of financing that comes up from within my business activities, or it could be an external source. I raise capital from outside the scope of the firm. Now, what is the key difference between them? When you are talking about internal source of finance, we are raising some capital coming out of the business operations itself. So you don't need the approval of anyone beyond the directors and management of the business. If the managers and the directors are fine with raising the capital through the internal mechanisms, they can very well do it. They don't need the approval of the shareholders or the other investors of the business and all. Whereas whenever you are looking at the external sources of finance, you require the compliance or the approval of so many participants like the various other stakeholders, other lenders. There could be various other people who would be involved in the process. So whenever you are trying to raise a capital through any external source, you have to be there is a slightly a lengthier process compared to raising an internal source. So that's one thing which anyone has to understand. Should I raise capital internally or externally? Of course, both of them will have their own limitations, right? If I'm talking about internal, do I have potential to raise that much of a capital internally? Or when I'm thinking of external, can someone give me that much of a capital for running this business? So first of all, from our side, before we approach or before we choose a particular process of raising capital, we need to have our own internal debate on whether it is appropriate for us to raise capital internally or externally. Now that is one dimension. The second dimension I require everyone to look at when raising capital is, do I need a long term capital or a short term? When I say short term, the payback has to happen within 1 year. Whatever you have borrowed or whatever you have raised, the payment has to happen within 1 year itself. Whereas whenever you are talking about a long term source of finance, the payment may happen beyond the scope of the next financial year. So it may be for a longer period. Whatever may be the mode, whatever may be the variety of capital that is raised, internal, external, but if it is a long term source of capital, then we say that the repayment of it need not happen within the next financial year. Whereas if it is a short term mode of finance, the repayment has to happen within the next financial year. And the third dimension which I suggest people should look at is every mode of raising capital has a risk associated with it. What do you mean by risk? Someone who is lending to you, or someone who is giving the capital to you in any form, he perceives some amount of risk. What could be the risk? Probably your business may not be successful. You may not generate the amount of profit which the investor is thinking that you would. You may underperform his expectations. These are all the risks which the other party who is providing the source of capital to your business would be typically looking. So, the higher the risk that is associated, you will have to compensate that particular party with a high level of return. So, finance always talks about this relationship. Higher the risk, the higher is the return. A very governing principle in the whole world of finance. So, typically, the level of gearing, we discussed this word gearing earlier. What is this gearing? The presence of fixed costs in the business. The extent of fixed costs in the business. What are those fixed costs? From an operating standpoint, your fixed costs, and from a financing standpoint, your already existing debt, because interest is a fixed cost. So, if at all the company is already having a good amount of debts, probably the other modes of investors, the investors who are now looking at providing capital to the business, they will be slightly hesitating because you already have some amount of debts in your business. So would you be in a position to pay us if I give some additional capital to your business? That's a kind of worry which a new investor, which a new lender, or which a new provider of finance would typically have on the business. So with that as a preliminary start off, let's look at what are the various sources that are available. What are some of the internal sources, some of the external sources, both in the long term as well as in the short term. Now let's start off with the internal sources. The most common internal source of finance for the business is retained profit. This is from the operations itself. As the word itself is saying, retained profits. The company has generated some profit during the year, right? Normally speaking, who would be the recipients of this profit? Anyone who has invested in the business as a partner, or typically a shareholder in the business. That particular person or an entity would be entitled to all the profits of the business. So it should be the practice that the company, once it generates a profit out of its operations in this particular year, it has to distribute that profits to all the partners and shareholders of the business. But what could typically happen is, if it distributes all the profits, then for the next year the profits the capital may or may not be available for running the operations. So it's as good as the business comes to a halt, or probably the investors should again reinvest fresh capital into the business in the next year. So to avoid all these things, the scenario is the management and the board of directors, they have the right to retain the profits of the business. So let's say a company has generated a profit of 100 crores this year. They may say we will distribute only 20 crores of this profit to the investors, to the shareholders, to the partners, whosoever have invested or whosoever have a share in the business. We will be distributing the 20 crores among the various shareholders of the business, whereas the remaining 80 crores we will be retaining and using it as excess capital for running the business operations for the next year. This is a major internal source of finance. But yeah, as you are clearly seeing here, there is a limitation. The maximum capital that can come up is to the extent of maximum profit the company is generating during the year. If I need more capital, let's say 100 crores is the profit that has been generated in this year. But if the company requires 300 crores to expand its business this year, internally it can raise only 100 crores because it is limited by the extent of profit that was generated during the year. Right? So, but yeah, it's better for you to understand that one key source of internal source of finance for the long term is the retained profits itself. And then what are the various short term sources? This is an interesting part. For a smaller period, if the company wants some capital, more from a working capital management standpoint, if we see in our previous session also, we talked a lot from a working capital perspective using the words like accounts receivables, accounts payables, cash, inventory, etc. These are some of the things in the short run which can help us either in creating the capital or destroying the capital for us. So if at all I have to create some short term source of capital internally, there are three suggestions that have been talked about. So probably you can have your logical perspective to this. Tighter credit control of the receivables. What does this mean? Don't give too much of credit. Don't sell too much of goods on credit to your customers, or keep the credit terms very tight. So because of that, what could happen is the cash keeps continuously flowing into the business. You don't have at any point in time, you don't have too much of outstanding to be received from your customers. So there is some kind of a capital that is always available in your business for the day-to-day activities. So tighter credit control of the receivables or debtors will definitely help us in managing the capital better for the short term. Similarly, reduce inventory levels. Inventory is nothing but the money in the not in the form of a cash but in the form of a stock. Right? If I'm having so much of raw material in my godown, it cannot be converted into cash immediately, but it has some worth to it, and I cannot use it for any other purpose. I cannot I cannot use my raw material to purchase something else. But if I have cash, I can use it to purchase something else. Right? So if I'm having higher levels of inventory, which means a good amount of my capital is not in a cash kind of a form, which can be used for any other investment, but most of it is in the form of raw materials which can't be used for any other purpose. So by reducing the inventory levels, I can really circulate the cash in a much better manner internally, which can help me manage my day-to-day operations in a very effective manner. So reducing the inventory levels is also another form of short-term financing. Similarly, delaying payments to the creditors. So if I've taken the raw materials from my vendor, if I pay him back immediately, then the money in circulation internally would be tighter. But if I delay the payment to him, there is a good chance that I can use the money internally for various other purposes. So there is a capital that is getting created virtually. So, following these three, or one or two or three of all these three, would definitely result in better short term capital for the business. So, internally, there are four different ways the companies can focus in terms of raising capital. From a long term perspective, the retained profits will definitely be useful. But from a short term perspective, the company should focus in terms of reducing the inventory levels or tightening the credit controls to the customers, or probably delaying the payments to the vendors. All these things would definitely result in creating some internal sources of finance. Is this fine? All right. Let's move on to a couple of important questions. This is a very common question which I keep hearing from people. Okay, retained profits are a source of finance, but is it a free source of finance? Which means when a company has retained its profits for expansion, is it available for free? The answer is a simple no. Logically speaking, if that profit has been distributed to the shareholders, they would have invested it somewhere else and got some kind of a return on that investment. Now, because you did not give that profit to the investors and you have retained it, the minimum expectation from the shareholders is that you generate at least that much of a profit, at least that much of a return on that investment which they would have got if they had invested it outside. So the retained earnings may be a slightly cheaper mode of financing compared to raising a fresh share in the business or bringing in a new partner into the business, but it is not the zero charge form of financing. I hope you are clear with this. And generally, when do the companies think of retaining large profits? There is a positive side, there is a negative side. If a company is expanding, it wants to retain more and more so that it can fund for the growth of the company. Whereas the negative side is, if the company is not doing well, it thinks that paying a portion of the profits is a burden to them, so they don't want to pay the profits in that particular year. So it doesn't mean if the company has retained a large volume of the profit, it doesn't mean that they are always in the mode of expansion. It could also talk about the financial difficulties of the firm. So you have to be very clear when you are analyzing why did this particular company retain a large amount of its profits. All right. Now, in the internal finance, we have looked at those are the mechanisms that are available with the firms. Now, going back or getting into the other world, which is the external source of financing. Again, within the external world, external means I am not raising anything from within the company. I am looking for someone funding my business outside the scope of the company. Again, there could be a long-term source versus a short-term source. In long term, there are so many mechanisms. Ordinary shareholders, ordinary shares, preference shares, loans. In loans, again, there are multiple variants. Leasings, hire purchasings. Today, there are so many different ways in which capital can be raised from external sources. Let's spend a small amount of time in understanding each of these things. Right, probably it will have its own time in terms of discussing each of these activities, but let me just introduce you to these various forms of long term financing. Ordinary shares, it's nothing but partnership in a big firm, right? When someone is joining you as a partner in the business, like probably we would be saying 50-50 share. What does that mean? Out of the profits, whatever I am generating, 50% will be given to my partner and 50% to me. What if the number of partners are increasing? 10, 20, 100, 1000, 5000, 25,000. few lakhs, few crores. Those are called as shares. You are making so many shareholders, so many investors. You are attracting capital from large number of people and giving them a part ownership in the company. So what typically happens is when a company is initiated, the whole capital of the company is divided into some number of shares. Let's say 10 crores shares. The whole capital of the company is divided into 10 crore shares of 10 rupees each. So the total capital of the company is 100 crores. So each share is having a value of 10 rupees, and like that there are 10 crore shares. Now the company can typically look at issuing these 10 out of these, let's say 10 crore shares. The initial promoters may think, let's keep the 5 crore shares, which is worth 50 crores, and let's raise the capital from the public for the remaining 50 crores. And who will give that 50 crores? Different people may give different amounts. So what they would be doing is, depending on how much amount each person has contributed. Let's say I have contributed 1 lakh. Then, because the worth of each share is 10 rupees, I would be given 10,000 shares of the business. So, out of the total profit that comes out of the business, whatever is the proportion corresponding to 10,000 shares would be given to me as my share of the profits. So, ordinary shares are nothing but you are raising the capital from the public, allotting them some number of shares based on the amount of what they have invested in the company, and you are distributing them a share in the profits of the company, not a fixed amount. So if the company has generated a very heavy profit, they would be receiving heavy amount. If the company has generated losses, even they would be receiving their share of losses. So that is the form of ordinary shares investment, typically treated as the most risky form of investment, because when you lose, you may lose heavily as an investor. When you gain, you may gain heavily. So because of that, there is a large amount of risk that is associated with the ordinary share form of an investment. Then we will talk about the preference shares, which is more in terms of the same ordinary shares, but the only difference, or but the prime difference being, instead of paying a share in the profit, they would be paid a fixed amount. Let's say 10% of the face value would be paid as a dividend every year. But the possibility is, in case the company does not generate a profit, they may not, or they may postpone the payment of the preference dividend. But even if the company generates a very heavy profit, these investors, the preference share investors, would be receiving only a fixed proportion, fixed percentage in the form of a dividend. So that means this is slightly less risky, because even if the ordinary shares are not paid the dividend, the preference shares may be paid the dividend. So the priority wise, the preference shareholders have a slightly higher priority compared to the ordinary share investors. So that is one of the reasons preference share based investment is slightly more less riskier form of investment compared to an ordinary share. Then today, the loans are taking multiple forms. Loans can be obtained from banks, various financial institutions, and the only difference between the loans and the shares is the person who has invested in the form of shares, he would be responsible for the profit and loss of the company. If the company generates a profit, he would be getting his share of profit. If the company generates a loss, he would be getting his share of loss. So, whatever he is receiving is primarily based on the profitability of the company. Whereas when it comes to the loans, the person who has lended or loaned to the company, it could be a bank, it could be a financial institution, or it could be anything. The entity or a person who has loaned to the company, they are not bothered about the profits of that company. They should be paid a fixed amount at the end of every year, right? So the rate is fixed at the beginning of the loan itself, and the payment of that fixed amount, which is called as an interest, has to happen every year. So irrespective of the profitability of the company, the loan investors are typically the lenders. They are getting their returns back every year. So that is one of the prime reasons the loans are typically treated as the least risky form of financing. So the interest rates also that would be associated with the loans would be much lesser compared to preference shares and much lesser compared to ordinary shares. See, risk wise, a simple classification in terms of risk, probably the ordinary shares have a higher risk compared to preference shares, which in turn have a higher risk compared to loans, which means the loans are the least risky. So the expected return wise also, the expectation, the higher the risk, the higher should be the return. Even the expectations of the returns, ordinary shares should be higher than the preference shares, should be higher than the loans. So that's the reason for the loans, the interest rates will be very, very less. Let's say if it is 10% here for loans, for preference shares maybe slightly higher to the extent of 10, and for equity shares or ordinary shares, probably the investors are expecting on an average 12% every year. Probably in some years they may be getting more than that, in some years they may be getting lesser than that, but on an average they should be expecting more than what a preference shareholders or what a lenders are typically expecting because of the risks associated with the investments. And within the loans, there are multiple categories. Let's say euro bonds. It is nothing but raising a capital in some other country, currency of some other country. An Indian company raising capital from US or raising capital from UK in the pound sterling, not in Indian rupees. Those are called as euro bonds, right? The characteristics are still similar. Anything which is a bond or anything with loans, they have two major categories: the bonds as well as loans. Loan is something just like your housing loans and vehicle loan, where the payments happen in such a way that in the form of EMIs, there is some amount of principal that is repaid every year along with the interest. Whereas when we are talking about a typical traditional bond, we see that the interest is paid at the end of every period, but the principal is paid in lump sum at the end of the maturity period. A very basic characteristic between the two, but whatever are they, that the returns are more or less uniform. The returns are more or less lesser compared to an ordinary share or a preference share. Then there are some new instruments that have come up in the market in the last couple of decades, which are convertible bond. A loan can be converted into an equity share, into an ordinary share. A bond can be converted into an ordinary share at a future date at a fixed price. Whereas the lender has the option for that. If he wants to convert, he can convert it into a share. If he does not want, he can continue it as a bond. That is the feature of a convertible bond. So initially he would be issued a bond, which means some interest would be paid to him every year until the bond is existing. After a few years, let's say after 3 years, the company will give him a right or an option to convert it into ordinary share if he really wants. So if he wants to convert it into an ordinary share, he has to pay a fixed price which is mentioned at the beginning of the contract itself, beginning of the issue of the bond itself. And that becomes an ordinary share from that day onwards, which means the interest will not be paid, but a share in the profits will be made. So the typical scenario what people use is they typically convert it into equity share if they are seeing that the share price is much higher than the bond value at that particular point in time. We'll look at a little bit more about it slightly in a couple of slides from now. Then we are also talking about warrant. Warrant is also a kind of an option that is being given to purchase some number of shares at a predetermined price. So this is also a kind of a convertibility that is associated with a bond. But the only difference between a convertible bond and a warrant is these two are two separate instruments. So probably it's like this. When you say a convertible bond, there is a bond plus option to convert. These two are bundled together and sold. Whereas when I'm talking about a warrant, there is a bond and there is a warrant. So this is a separate instrument, this is a separate instrument. So what could happen is, in this case, the person can retain the bond and sell the warrant to someone. So that selling off means the person can pay some amount and acquire the share. Whereas in this case, it is happening like you are surrendering the bond to acquire the share. Because here it's in a convertible bond, it's a combo. Whereas in a warrant, these two are two separate instruments. Yeah, but for our simple understanding, whenever we are talking about the loan form of financing today, there are so many mechanisms that are available in the market. All right. And another most important form of financing that is hitting the limelights in the recent years has been the leasing and the hire purchasing agreements. It is mostly associated with the buying of some assets, machineries, plants, equipments. Instead of buying them, I can lease them. Leasing means it's as good as rental. Leasing is as good as a rental. So someone is buying it on my behalf and I'm using it but paying rental to that party on a regular basis. That is what is the typical concept of leasing. Hire purchasing, again a word. Hire purchase. I am purchasing something in such a way that I am paying to the other person in form of installments. I am paying it to my vendor in the form of installments. So because of that, what is happening? If I do an outright purchase of a machine or an equipment, there is a shortage of capital immediately for me. Whereas when I am going through the leasing method, where I am paying only some portion of the cost of it, which is making my capital more and more in my hands. I have the flexibility to manage my capital, but at the same time get the advantages of the usage of the asset. So, as a company, I would be more interested in leasing or hire purchasing compared to the possession of the asset. But yeah, what is the benefit to a person who has given it on a lease to me? The advantage that party would be getting is in the form of interest. So, which means if he has bought something and given to this company on a lease, the rentals which he would be charging would be in such a way that annually he would be receiving, let's say, 12 or 15% return on that kind of in the form of rentals. So the straightforward thing is he has invested not directly in the company, but he has invested in some machines and equipment, and he is renting out those machines and equipment, and as a service to that, the companies are paying some kind of return in some kind of return, 12 to 15% for using that particular asset. But the advantage to the company is an outright purchase means cash flow shortage along with a lot of other problems which I would be discussing slightly later. But the benefits are more. The cash is available, the capital is available for some other purposes, and at the same time the company can probably get out of that particular equipment after a couple of years if it really feels that that particular machine or equipment is obsolete. So some of the things which any company has to typically look at when it is choosing the borrowing is look at the nature of the assets held. Do I have more of fixed assets, long term or short term assets? What are my assets that are available? And if I have more of long term assets, then probably the long term borrowing would be more and more appropriate. The need for flexibility. When do I need how much money? If I have a plan of expansion where the capital is needed over a long period, not over a short period, then choosing a longer term financing is more appropriate compared to a short one. The refunding risk. What is the potential of the company in terms of paying back and refunding it? What are the interest rates that are currently prevailing? If the interest rates are very, very high, then probably it's better to go for the share capital kind of a financing. But if the interest rates are pretty low, then probably even a loan based financing is not a bad option. So there are various things that every company has to typically look at while choosing its various financing mechanisms. Now, we have looked at the long term sources of finance from external sources, whereas there could be a short term sources of finance also. The most important thing which a lot of companies depend on is the bank overdraft. It is as good as maintain a negative balance in your bank account. That is what we call as an overdraft. So, which means whenever you get some kind of cash, it gets adjusted. But in case at some point in time, you need some additional cash, you need some additional capital, you can very well borrow from the bank, which means there is a negative balance that is going into your account for which the interest would be charged over a small period of time for whatever the period you are maintaining a negative balance. But after that, it once the moment the amount comes into the account, it gets auto adjusted. So a bank overdraft is a very simple and better source of financing for short term purposes. Quickly, if you are falling short of cash for a small period and you are expecting some cash or some kind of sales happening in the next couple of days, then it's better to have an overdraft, pay some minimum interest on that for a very small period, and you can again replenish the cash back. That is one mechanism. The second is debt factoring. It's as simple as the company, look at this mechanism. If the company has sold some goods on credit, right? I'm selling some goods on credit to a customer. The factor, which is typically a financial institution or a bank, what it does is it invoices the customer. So it raises the bill from the customer. And the moment it invoices, it pays some amount of it, assessing the risk associated with that selling. It pays some portion of that. Let's say, okay, this company has sold some tables to this customer to the worth of 100 crores. Now, the invoice will be raised by the bank to this customer. And at the same time, the bank would be paying, let's say, some 75 to 80%. 80 crores will be paid to this customer, to this vendor, which is the company. And once the customer pays, in case the customer pays, and depending on the time period on which the customer pays, this company will pay back the remaining amount to the company. The bank or the financial institution will pay the remaining amount back to the company. But of course, for whatever the period the customer did not pay, some kind of, or whatever the payment that could not be collected, what typically happens is there is a fee that is adjusted and that is paid back to the company. The advantage the company gets here is fairly simple. They are getting cash immediately, though they are doing a credit business, though they are doing credit sales to their customers and maintaining their customer relationship. They are not getting stuck on cash. The reason being, the bank or the financial institution which is acting as factor to them is immediately providing them with the sufficient necessary cash. So they have to pay a small amount of fees to the bank or a financial institution for giving them that kind of a capital in the short run. So it's as good as they have sold the goods on cash and got the customers. Whereas in reality, they have sold it on credit, but the financial institution is facilitating them with the cash immediately. So this is also a kind of external source of short-term finance. On a similar lines, we are talking about invoice discounting. Every sale that the company has made, whatever is the outstanding credit sales that is existing with the company, probably it's called like whatever are the outstanding accounts receivables of this company at this moment, the factor will provide, let's say, 80% of this account receivables as an immediate cash to the bank, and after that it will be charging a small fee or an interest on the receivables part. So for whatever the financing it has done, immediately there would be a small fee that would be levied on that. So in that way, the companies can raise capital in the short term using all their outstandings, whatever are existing, or whatever are the sales that have been made during a particular period. Using all these scenarios, the companies can typically raise capital for a short term period. But yes, which mode has to be used at what point in time, completely determined based on the risk that is associated, the amount of requirement in each of the periods, the interest rates associated for each form of financing. All these need to be taken into consideration. All these above models which we have discussed, they may be very much appropriate for pretty large companies or at least medium sized enterprises whether it is a loan or a share capital. Because if some company requires to raise a share capital, there is a possibility that it has to be in operations for quite good number of period. It has to showcase a decent workout in terms of profitabilities over the last few years. But if it is completely new business, small business, but it can't get loan because it doesn't have too much of collaterals existing. So when this kind of limitations are there, the small businesses can typically look forward to other sources of financing like venture capital. So there could be some venture capitalists whose major intention is to fund these small businesses which are risky, but at the same time, because these businesses are risky, they will definitely have an advantage in terms of expecting higher returns from these businesses. So venture capital funding is one of the most important ways of funding for these kind of small businesses. And along with that, we also have the scenario of angel investors who are nothing but wealthy individuals who are willing to invest in very early stages of development. Because in the very early stage, just like an idea generation phase of the business, you will typically find a make or a break. The moment if the business idea is successful, it generates huge volumes of profits, whereas if it is a dud, it completely fails at the customer space. So the business angels are these guys who would be investing in the very initial stages of the project, very initial stage of the business. They are interested in getting pretty heavy returns in the very early stages itself. That would benefit both the investors as well as the entrepreneurs. The reason being, an entrepreneur at least need not take the loan in the initial stage and risk himself, and at the same time just with an idea, and he can get his idea implemented very effectively. He knows the business model of his idea. When someone is there to invest in that idea, there is a lot of effectiveness that comes out for him. Similarly, apart from venture capitals and the business angels, we also see that the government also assists these small businesses through guaranteeing loans, tax incentives, grants. A lot of these things can very well come up. So, in a nutshell, if we look at in this chapter, the major focus was understanding the various sources of financing that are available to a company, both in the short term as well as in the long term, internal as well as external. What are the merits and disadvantages associated with each of these modes of financing? And finally, a look through into the small businesses. What are the various avenues available for small businesses which do not have much access to share capitals as well as the loan funds? What are the various mechanisms for them to raise their capital? I hope you are comfortable with these various areas of sources of finance. If you have any further queries, you can even call me up at any point in time, even at a later point on this number, or you can send me an email on the email address which I have provided there. All right. If you have no further doubts, we can end this session, because the prime intention of this entire program was to give you the awareness on three major aspects: the financial accounting part, the management accounting part, and finally the introduction to the financial management aspect. Right? But this should help you in starting to go deeper and deeper into understanding each and every chapter which was discussed, and finally build yourself a great amount of knowledge in the world of finance. All right. Thank you very much for attending this session.